on my channel last 7 years, I want to say the last six, from 2018 to 2024, the bulk of the content has been a number one focus priority is the cash value and how you can use it now and pay off debt and do all these wonderful things. And then similar to what happened to you, I had a incident in my own life, not me personally, but someone very close to me, my sister-in-law, was in a terrible car accident that she nearly lost her life. And she had to undergo multiple surgeries. This is a healthy kid, 20 years old, and in perfect health. And I had the honor to put a policy on her around September of 2024. And the car accident happened on October 4th of 2024. So we're talking weeks right after the policy was in force, like right after. And then this event occurs, and I'm sitting here like, I never even paid attention to the death benefit. Even when I was presenting to her, I was like, this is the most important column for you right now. This is where you're going to save money. This is how much money you're going to be saving. She's going to do a $10,000 a year policy. We chose Mass Mutual. And you're just going to save your money here, and we're going to build the discipline of saving money. Comes with this big old death benefit right here that you really don't need to worry about. If anything happens, we've got that death benefit. Now, your family be taken care of, but this is what it is. And so now after that event and then other stories that I've heard along the way, I'm like, oh, wow, how can I not only talk about the cash value component, which is still a very important piece. It's why, again, 9 out of 10 people are going to sign up, or why they're going to do it in the first place. But also say, hey, you're 40 years old, you're 45, you're 50, 3 kids, 4 kids, married, the whole deal. Maybe there's some balance
Definitely is.
of priorities in, yes, high cash value, and maybe also a component of, do we have enough death benefit on this policy, knowing that it could have an impact on your cash value performance in the early years, but is that worth it for that kind of person, and
Yeah.
under those situations? Have you felt that way over
Um,
going into this new season, where you felt the need to maybe talk a little bit more about the death benefit with clients, or even
yeah.
with your team, your agents, your sales agents,
Good.
or any changes there?
Yeah, good question. So not a whole lot as far as like putting it on someone to say, hey, like let's make sure that we really try to sell more death benefit or trying to emphasize this sometimes. But I've always tried to focus on what the consumer wants to focus on and start there, and then add some additional benefits like, hey, here's a reason why we might want to consider the death benefit, or hey, here's how other people view the death benefit. I can give you a quick example that we've used a lot for people in retirement or very, very near retirement. It involves a strategy of leveraging typically an old IRA or 401k, and it has to do with taking the value of that, insuring it, producing income, and also leaving that to the next generation. So the idea of how do I spend my money and pass it, because you need the death benefit to be able to do that. As someone who's very concerned about generational wealth, and it works for somebody who's a multimillionaire or someone with a few $100,000 in an old 401k or IRA or something like that. Like we've been focusing on that type of planning quite a bit, and a lot of people are attracted to it. I can share an example of that, which kind of hits on that point of the death benefit, if you'd like.
Yeah, absolutely. Let's do that. That'd be awesome.
Okay. Yeah, definitely. So I'll use a recent case study as an example with a woman named Leslie, who I absolutely love speaking with. Like the energy with her and her family is so high, and she has a ton of fun talking about finance.
I love those
She
kind of
is,
people.
oh, she's fantastic. So I think she's 58. She'll be 59 in about a year. She's got an old qualified retirement account with like $225,000 in it. Now, she had expressed that what she wanted to do with that retirement account is not spend too much of it, because she wanted to be able to leave something to her children and grandchildren. Like that's important to her.
Mm-hmm.
So if she could grow it and leave something, that's ideal. Even though it would be taxed, it's still a balance that's going to them. That was very, very important to her. At the same time, if she could use some of that to supplement income, her income in retirement, like with Social Security, her husband's pension, is where she'll want it. But just with everything going up, she could use some additional income. Like it will put her in a position where she's like, all right, this is good.
Yeah.
Not now, but in 10 to 15 years from now, she definitely will. Or she thinks she will, and so do I. So what we did there is we've got that old retirement account with about $225,000. She's 58 now. What she can do is transfer that to an annuity. IRA to annuity. There's no taxes. That's just a rollover. I'm transferring it from a similar account. Then at 59 and a half, so about 1 year from the time of transfer, she flips the income switch on. Now that annuity produces a guaranteed income. I think hers was between 15 and 18K per year, but it was guaranteed income for the rest of her life. We flipped it on 1 year later because she didn't need it yet. So what we did is take that 15K per year and feed a life insurance policy for about 8 years. The reason why is because in 8 years, she'll be just past 65 and she might want to start taking the income. She might need it at that point in time. So funding a policy with just 15K per year for 8 years, instead of just setting the death benefit at the absolute minimum, guess where we set it?
Absolute
220.
Okay.
225 to insure the old IRA. Now she's got 225 in a life insurance benefit, which is paid income tax free to her beneficiaries if anything happens. So now you've insured that asset with a tax-free benefit instead of a tax-deferred.
Right.
Way better. But the cool part is it only needs 8 years of funding. You can get away with less, but we fund it for 8 years.
Yeah.
We don't do our classic chop the term rider off, drop the death benefit, maximize cash value growth. She could if she wants, and we'll show that when that time comes. But we keep the death benefit at 225. It goes up as time passes.
That's what I was gonna, ask.
Yeah.
15 grand that we're contributing. I'm assuming, there's that cash value growth that's gonna increase the death benefit.
Big time too. But she also stops after 8 years. So beginning year 9, all of the cash value continues to grow through dividends. That also pushes the death benefit up. But then after 8 years, that annuity is still producing 15K per year. She now takes that personally for personal income.
Okay.
While the life insurance policy sits on the back burner and grows, she's got cash value if she wants to access that money, which she can access tax-free now, by the way, which is sweet. But the annuity continues to pay. And if she makes it until she's call it 85 or take 90, I think we looked at, the total income that the annuity would produce, I can run the math. It was 15K for about 30 years there. I got it. So 450 grand. It was a little bit more because it wasn't exact 15. It was a bit more. Yeah. So she put in 225. She got 450 from the annuity. But at 90, the death benefit had appreciated. It was between 350 and 400. Call it three. It was about 400 actually.
Wow.
So what is that? Yeah. So not only did she get that 450, she used some of those 15K payments to put into a life insurance policy. Now 400 grand is paid income tax free to her beneficiaries. So you used 2 insurance products, an annuity with guarantees, a life insurance policy with guarantees. The market's not for her. It's just a peace of mind strategy that makes it easy. And you get the cash value, which is nice, and the death benefit, which satisfies that desire of leaving money to the next generation. But just from a tax efficiency standpoint, it makes it so much better, if you want to call it that. And you have no market risk either. So that's a high level overview. We've got a video on our channel. It's like 12 or 15 minutes that goes through that with visuals. But that's one strategy that does leverage the death benefit more. It's more so planning and coaching someone in retirement where you leverage different products.
For people listening, that might have flew over a lot of people's heads, but understanding that, there's a way to have your cake and eat it too, as it relates to a lot of folks that are 5, 10 years out from retirement, because there's this huge population of people retiring every single day, and then people that are 5, 10 years out from retirement, they've got money locked up in these qualified retirement accounts, and those accounts are great for accumulating wealth. But then the strategy must change when you get into the distribution phase, the sequencing of returns. And this is things that I've been learning about lately, and finally realizing, wait a second, this whole life policy, or these, there's the annuity, you dropped that in our conversation here, but focusing on the whole life policy, it has multiple functions and it solves for multiple things, and while simultaneously removes certain risk the older we get. And it's so interesting, us young guys, how we first started out. You bought your first policy at 23. I bought my first policy at 23 as well. And again, it was just a cash value. And with all my client base that I now have over the last 7 years, it's been all about the cash value. But in the last year, it's been just presenting the conversation, not, to your point, still focusing on what exactly the client wants, and then also saying, here's how others have viewed the death benefit. Here's an experience I've had that you may not have had yet, or maybe you did have, and we can actually incorporate some of that thinking into our design process to maximize all the benefits that could come with life insurance over the long haul. So I love that we're diving into that here with you, and really cracking open some potential scenarios, just like Leslie in that case. And quick question, with the funding of the 15,000, the split in terms of cash value to percentage of the 15 that goes to cash value versus death benefit, now that you're dealing with an older individual and there is a focus on solving for death benefit amount,
Mm-hmm.
does the break-even period, did it still end up kind of being similar to a
Yeah.
minimum
So
design, or is it slight difference, and
it's
anything you
ever
can
so
speak to
slight. Yeah. So the design of the policy was still a 1090, meaning 10% base premium, 90% PUA. We just added a little bit larger term insurance rider. That's how we got the death benefit to where we wanted. So the break even point was about year 5 instead of to where it would have been between years 3 and 4 if we just stripped the term down to the absolute minimum. We typically always shrink that base as low as we can. The simple reason why, we always did it for corporations. And when I track the actual results of policies, not just illustrations, but real policies that have lived the test of time, it always delivers the best results from a cash value performance standpoint. And then the policy with the greatest cash value will also have the greatest death benefit long term, typically right when you hit age 85, like when insurance companies are expecting us to kick the bucket. That's usually when we see the death benefit the highest too, with a high cash value policy. So we still did that. We just added more term. And when we looked at the different designs, like we always do, that one produced the most, if that makes sense.
Yeah, no, that's awesome. And it solved for exactly what she wanted. She wants to be able to leave money behind, but
Yeah.
now she's able to leave the whole 225 for the next generation and spend the 225 plus more, plus have reserves in the whole life, because although you're paying for death benefit, you also have a living benefit, which is the cash value, which is a lot of what we all like to look at. And she's got that reserve component, which all of that can be used tax-free in retirement as supplemental income, or take care of an emergency or an unexpected expense, really whatever she likes.
Yeah.
So I'm blown away by those factors.